Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, so today we're going to be talking about Pfizer. We're going to be talking about bottom fishing, and not only stocks like Pfizer, but something that you might feel comfortable buying 100 shares of as we are officially now in a bear market. Now, there are still recessionary concerns. We had some good data this week from housing. Unemployment is still at a decent rate relative. So the official talking heads have not came out and said that we are in recession, but there are looming conversations about it. So I figured it would be a time to talk a little bit about some of the more basic option strategies here on the stock play of the day. So we picked a stock like Pfizer, which has had earnings for forever and is trading at about a 9 PE. And there's quite a few major companies out there, well-known companies that are trading down around the 9, 10, 11, 12 PE and are just interesting candidates if you had some funds and you wanted to try to pick a bottom. Now, as always here on the stock play of the day, nothing's meant to be a recommendation. We're looking for situations where we can take trades from strategies that are inside the options playbook and apply it to that situation with that company, with that underlying stock. So before we get too far along, though, I want to talk about last week's trade. We are no longer doing the stock play of the day overtime, which is normally on Friday. So we're going to try to work it into this strategy. And that trade was in Nvidia, and we looked at a long call spread in Nvidia. And we're going to talk about, where is that underlying stock at now and what might be an adjustment that we would want to make based off of where Nvidia is trading currently. Okay, so before I get too far down the road, though, let's look at my VIX watch list. And the markets are very mixed today. We had a bad week last week as far as the markets were concerned on the downside. Well, I guess it wasn't bad if you were short the market, but we've so far this week have been a little bit of strength, but today we're really mixed. Not really sure which way we want to go. The VIX index still continues to trade at a decent level. I mean, I don't know what decent is anymore. I think as far as volatility is concerned in the VIX index, the range between 20 and 25 is really now the new low as far as volatility is concerned. That would be considered low volatility. I've mentioned many times that I still think the VIX should be up in the 30 range and should be just trading in that range. We're seeing actual standard deviation of the marketplace or movement being higher than what the VIX is implying. And we finally had a day just yesterday where we just didn't have a wild swing in the marketplace. That's the first time in, I'm going to say about 2 months, where we haven't had a 1.5% to 2% move in the S&P 500 index or other major indexes. So the VIX is actually under underestimating volatility. And one of the things that I'm going to highlight today that I want to draw attention to, because I've mentioned this before, is that we actually set a low in the VVIX. So the VIX of the VIX, not a lot of people talk about that, especially on a lot of the financial shows. But I mentioned just the other day that, let me see exactly what day this was, 6/2, it looks like, or 6/1 or 6/2. We actually hit a low on the VVIX since the pandemic, the lowest that the volatility of the options that trade on the VIX index on the spot under the symbol VIX was at the lowest since the pandemic. And I'm highlighting that on the chart right now, that range. And guess what? We just set another new low in the VVIX. So the marketplace, a lot of people seem concerned about the fact we're in a bear market. We have conflicting data as far as recession is concerned, but the volatility index and the fear index just isn't there. It's just not showing the angst in the marketplace. A lot of people have talked also and mentioned that if you look at the VIX, we haven't had that big spike up in the VIX. I'm going to add it to the chart right here. And that's that 40% level. I just keep, that's kind of my line in the sand as far as high volatility is concerned. We obviously see this huge run up that was caused when the pandemic was announced, when it officially became a pandemic. And we just haven't had that shake out of the marketplace where we had the big down day, the maybe 5 or 6% move in the SPX, and we see the VIX shoot up to the 40, 45, maybe even 50 range. That would give you the comfort that maybe we had some capitulation in the bottom of the market. So trying to bottom fish is tough, and it's been tough over the last month. Markets have stabilized a little bit. Well, let's say this week. I can't even say the last couple of weeks. I'd say just this week. Finally, a little bit of volatility has waned. But yeah, the VIX index is an interesting underlying, and maybe even next week, if we see the VVIX stay at these lower levels, the stock play of the day next week, we might just talk about the VIX. Why not? We're going into a holiday weekend. A lot of people have stopped thinking about the markets and are going to start thinking about what they're going to do over the 4th of July. And so we might look at a trade in the VIX index, which is a very advanced index to trade. I've written a lot of blogs and white papers on the VIX. So it's going to be a tough stock play of the day. I'm going to have to explain a lot because the VIX is definitely a different beast if you're considering trading it. Okay, so let's go back and look at Nvidia and see what has happened with our trade from last week. There's Pfizer. Let me try to find it here real quick. All right, so we're going to throw it right here. And our strategy for the week was a long call spread. And the long call spread, I need the, 1 second. There. I don't know why that wasn't working for me, but there we at. So when we looked at our long call spread, the market was at 168. We now see that it's down $8 today. So we're interested in semiconductors that have been very volatile underlyings. We kind of build it as a FOMO trade in that we're not necessarily ready to jump in, but just in case we do get the big move to the upside, what's a strategy that we can do? And the strategy that we looked at was a long call spread where we're managing our risk. We're not putting a lot out on the table, but we want to have a little bit of upside. So by doing the long call spread, that's how we would manage our risk. So in this instance, we went out to 17 days to the July 15th date. And we looked at buying the 175 and selling the 180. So let me pull up the strikes here. And the trade that when we initially put on the trade, we paid $1.50 for that trade. And now in this instance, we see that it's trading for $1. So we had the move against us. We're down about 50 cents on the trade. So the question becomes, would I want to get out of the trade at this point in time? Now, if I were to do this long call spread, we gave ourselves $3.50 worth of upside. It was a 5-point wide trade. We paid $1.50 for it. Our max risk was that $1.50 or $150 for every 1-by-1 spread that we did. But we gave ourselves $3.50 worth of upside on the trade. So if I'm thinking about this, if I'm down 50 cents on the trade, I'm probably still going to let it ride. I don't understand why I would panic on it. You might say to yourself, well, if I lose half of my investment, I might get out of the trade. But at this point in time, I would probably just stay the course and hope that I get that run up before that July 15th date. Now, if I did this trade and I sold the 180 and I bought the 185 here, if I wanted to try to say, okay, I'm down on the position, but I want to salvage a trade, I could actually roll this into a butterfly. Now, a butterfly trade would mean I'm going to buy one and I'm going to sell two of the middle strike. I'm going to bring in a net credit to the account and I'm going to offset some of my risk. And I'm still going to have a position on the long call spread, but now I have a fixed range that the underlying stock can finish at where I could be profitable on the trade. It's not what I would do in this instance, but I'd always like to mention a possible trade that we could do to try to adjust that position. So if we did that trade, here's where we started. Using the option strategy workbench. Long 175, sold 180. We would get rid of the 175, sell an additional 180, and then buy a 185. Right now, we could get that done for a net credit of 70 cents to the account. That means that we would be taking off 70 cents of the risk of the initial trade that we put on. And we would hope that the stock would still come back to the 180 level. That would be our range that we would want it to get there by. And we'd be looking to do that by that July 15th date. So when we're all said and done, what would happen if we look at our profit and loss graph here, our adjustment trade would be a short call spread. And this is what it looks like on our profit and loss graph inside the Ally Invest option chains. We'd be selling the 180, buying the 185. Our initial trade was buy the 175 and sell the 180, which means that we would have two of the middle strikes. And if we zoom in on this, this is what our ending up trade would look like. So we were long a call spread, sold an additional short call spread, and we end up with a butterfly. Underlying stock has gone against us. That's not good. We brought in a small net credit to the account to try to salvage the position. But if the stock goes anywhere near the 180 level, then we could, basically, the way I look at this is, I don't want the cheese anymore. Just let me out of the trap. I am putting on this position, hoping that I do get that bounce back to the 180 level. I'm taking a little bit of risk off of the table by selling a credit spread. I'm not adding any margin to my trade, and now I'm just going to let it run. So as opposed to going out and just selling and getting out of the position at $1, I'm going to take a little less. In our instance, it was 70 cents, so I'm going to take 70 cents instead of $1 out of the trade. But I still have a possibility that if it landed somewhere between 175 and 180, or 185, and it made that move, that I could maybe get my money back or get out at a small profit. I'm no longer looking for the home run. I'm no longer looking to pay $1.50 hoping that I can make $3.50. I'm hoping that I can get out at least break even and maybe have a small gain. Now that I've done this trade and I've adjusted it, I'm happy to just let it ride. Let's ride all the way out to the expiration date. As a matter of fact, you kind of see here, once you put this position on, as expiration approaches, the green line is showing your profit and loss graph as of right now. As expiration approaches, let's go all the way down to 1 day to expiration, and we'll hit graph. Now, all of a sudden, the green line, the as of today, the what if scenario is looking more and more impressive, like the dotted line of the butterfly at the expiration date. So here's a possible adjustment. Market has gone against us pretty heavily. Options still have a little bit of value in them. You could sell and get out, take your comeuppance and move on and look for another trade, or you can try to adjust the position. One of my favorite things to do with a long call spread is to just roll it into a butterfly, and then I can just let the position sit, set an alert. If I see it anywhere around the 175 to 180 range, I want to look at my butterfly, see where it's at, and pick when I would like to get out of that trade. If it continues on down, I can't lose anymore. My risk is limited to the net debit that I paid. If I brought in a 70-cent net credit to the account, that means it's 150 minus 70. I have 80 cents of risk, or $80 on my 1-by-1 long call spread that I initially put on. And don't forget, you got to add in commissions. It's always important to think about commissions. They're still paying commissions if you're trading options. All right, so that was the trade that we were looking at from last week. So now let's jump in and let's talk a little bit about Pfizer. So I'm going to pull up the chart on Pfizer, and Pfizer is trading at a very low PE relative to even some of the pharmaceutical stocks. And we see that here was a range where we saw a little bit of support in Pfizer. We see the breakout here on the underlying stock back in November. We had a gap up in the marketplace. And at that point in time, all the ducks were in a row. You were above the 200-day, above the 20-day, above the 50-day moving average. And then we had this, what's called a golden cross, where the 20-day crosses over the 50-day and everything comes in alignment. Had a real strong move to the upside. That area seemed to provide a lot of support in the stock. In March, we came down to that level right there, trading right at the gap opening here has provided some support. So now we're trading in a channel. Without a doubt, we're within a channel on Pfizer. So let's do some bottom fishing. If I was interested in buying Pfizer at a lower rate, how might I do that using options? We see we got a whole cluster on the chart right around all the moving averages, the 200, the 50, the 20-day. Strong move up recently. If we do get a pullback down to the 50 range, down in this area where we see a lot of support right here, had a little bit of a bounce down around the 47 area. I would be nervous if we would have broke through this 45 range, right? So there's a lot to be nervous about in the marketplace. But how can I use some capital that I may have on the sidelines? It's a fairly low price stock, right? It's $50.71 right now. So 100 shares would be $5,071, and that would be my total risk on the trade, and I could buy 100 shares. So I'm going to sell that 50 strike put option, and I'm going to try to bring in some capital. There's a lot of premium in the marketplace. VIX is, even though the VIX I think could be higher, the VIX right now is still trading around 27, which usually means that in general all stocks have a little bit higher implied volatilities, and that is the case with Pfizer. So I'm going to take a second to run over to the Pfizer chains, and we're going to go out 17 days in time. We're going to look at the July 15 date, and in this instance, we're going to just go over the next 17 days. If Pfizer does come back within that range where we saw a lot of chop, I'm going to sell that 50 strike put, and I'm going to bring in about 92 cents. That means for every put that I sell, I'm going to bring in $92 less commission. Now, we're going to do this on a cash secured basis, meaning that if it does come down to that range, I intend to buy 100 shares at $50. You can do this in a retirement account as long as you have the correct approvals. If you filled out an option application and they gave you that wherewithal to be able to trade options, one of the lowest requirements is selling cash secured puts and selling covered calls. A cash secured put is very similar to a covered call in that you have the same type of risk as if you just bought the stock outright. And if you have the cash in the account to be able to buy that stock, well then there's not much difference than buying Pfizer outright, except for you're saying that you're willing to buy the stock at a lower price. So it's going to be a very simple paper trade this week. we're going to sell the 50 strike put. Right now it's trading at 93 cents. It's a decent market, 91 by 94. So maybe I put it in at 92. Let's go and say 92. We're trying to grab a penny of it. I'm going to put it in the right rail. That makes it the official paper trade for the week. And we'll put the limit price at 92 cents. Saying that if the market does come down to this level, we're not going to sell it right at 91, right at the bid. We're trying to grab a penny out of this. We're going to bring in $92 less commissions to do that trade. Right now, the bid is actually at 92, so I would probably just send it right at that level. I never do market orders, even if I'm doing individual options. I'm always going to put a limit in. I want to define what I'm willing to accept as far as my trade is concerned. So we see that we're doing it for a limit. It's going to be a credit to the account of 92 cents, and this would be the paper trade for the week. So if we look at the profit and loss graph, let me pull that up on this, and we'll get rid of the right rail here. You see how we have similar risk to owning the stock outright. So I'm going to zoom in. And if we own stock outright, we have substantial downside, right? But we have unlimited upside by buying the stock outright. Now, if we sell the put, the stock is trading right here, right at this level, right where that gray line is. We sell the put, we're saying we're willing to buy the stock at the lower price. And then if we buy the stock, we wouldn't mind holding it long term. That would be the concept of it. The cash secured put is right here in the options playbook. And note we have it a little different than if you just sold a put. On the cash secured put, we actually drew the dotted line as the profit and loss graph if you were put the stock. Because the concept would be that I'm selling this, trying to bottom fish, trying to pick a spot where I wouldn't mind buying a stock like Pfizer and buying 100 shares of it. And once I do, then I have substantial upside and limited and known downside. If you put the stock to me at 50, I actually officially buy it. If I can sell it for 92 cents, I would buy it at 49.08, right? So I do get that premium, so I can use that on my cost basis. So if I bought the stock outright, my cost basis would be right here. My cost basis would be where that underlying stock is at. Now we're saying we're willing to buy it a little bit lower, down around the 50-cent level. We're going to bring in a net credit of 92 cents to the account. So our official price would be, if you use that premium to help buy the stock, our cost basis in that instance would be 49.08. All right, so that's a cash secured put. Now, I mentioned that it looks a lot like a covered call. And if you look at the graph synthetically, I'm going to pull up a covered call inside the options playbook. You will see that they're very similar, right? This is the covered call. This is the cash secured put. The difference is that if you do the covered call, you own the stock. You sell a call against the position, saying that you can call the stock away from me at that strike price. So you limit your upside on a stock that you own. In this instance, on the cash secured put, we're saying that if the stock goes up, well, we have limited and known upside potential. But if it comes down, we're willing to buy that underlying stock. So as far as the risk is concerned, in this instance, we sell the put. We have risk if the market goes down. In this instance, we own the stock and we have risk if the market goes down. So they're synthetically the same strategy. And I mentioned the covered call because if I'm bottom fishing in this environment and I get put the stock, I would consider selling a call against that position. I would pick the time. I don't necessarily want to do it around earnings or whatever because I don't want to cap my upside on it. But these are two ways where you could dip your toe in the water, find some lower price stocks that you wouldn't mind owning, sell a cash secured put to buy it, and potentially sell a covered call once you get put the stock, saying that if the market does go up, I'm willing to bring in cash now to say I would sell my stock later at a higher price. All right, so very simple, straightforward trade this week. And I'm not, as always, Pfizer is a stock just that's trading at a fairly low PE, pretty big mega cap pharmaceutical company. And when I'm bottom fishing, a lot, cash secured puts is a very interesting strategy to talk about. I haven't talked about it a lot on the stock play of the day. recently because we really haven't had that opportunity. When you're in a bull market and the markets are just continuing to go up like they were about 6 months ago, cash secured puts aren't necessary. The market doesn't come down, doesn't give you that opportunity to buy. So this is the type of marketplace where I really like the concept of cash secured puts and maybe even a covered call. I don't want to cap my upside necessarily. I got to pick the right stock to be looking at it on. But these are two types of strategies that I think you should have in your tool chest to help manage your portfolio. All right, so that was a lot. We covered a lot in the last 20 some minutes. If you have any questions, please put them in the chat box. I'll try to address them. We can talk a little bit about Nvidia if you'd like to, and that adjustment. That was a fairly big adjustment in a quick, in a few minutes. But if we're looking at the bottom fishing, I do think we should talk a little bit more about cash secured put selling. All right. So do we have any questions inside the chat box? If not, that's all right. No problem. We can move on with the trade. Calling once, going twice. All right. I don't see anything in the chat box at this point in time. So please click subscribe. Please ring the bell. Please share this on social media with anybody that you would find that you might find interesting. We're going to try to continue to talk about the trade from the previous week, talk about a potential adjustment, and always look at a new strategy week in and week out. Thanks for coming for the stock play of the day, and we'll see you next Tuesday.